Good morning. Welcome back to Squawk. Let's get now to Dodge. Dorland Dodge is the chairman and chief investment officer at Landor and Foos Capital Managers. He's joining us now from New York, and also with us our guest host this morning, Yu-Dee Chang from ACE Investment Strategists. Thanks to both of you for joining us here on Squawk. It's a Tuesday morning. Negative lead from Wall Street. Dodge, when we look at the numbers for the Dow, the S&P, and the NASDAQ, the numbers aren't great, the finishing levels, but they're off of the intraday lows. And overall, I think you can argue that the market has been relatively resilient, all things considered. Why is that, considering the economic data and forecasts have been so dismal?
It is relatively better. It's also relative not only to our markets, but also to other markets in the world. And the fact that our cost of fund is so low at this point makes the stocks a very potential high-yielding opportunity, high relative to the other alternatives. And so what we're seeing is strength more in the yielding stocks, less opportunities in capital appreciation at this point.
All right, let's talk about those high-yielding stocks, those blue chips that investors have been so in love with because of the dividends that they pay out. But they're looking a little expensive at these levels. And when you look at their revenue forecast for Q3 and Q4, we're looking at levels we haven't seen since 2008, 2007, at the height of the financial crisis. Do you think there's a possibility just keep piling into these stocks, get burned on the share price at some point in the very near future?
Potentially on the short term, yes. And in fact, don't forget, Lisa, we're coming into a new year where there's a potential increase in our tax rates. And so there may be a demand for selling stocks before the end of the year and taking whatever profits there are before the increase in taxes. So we do expect that there could be some volatility in those stocks. Those who are buying the dividend stocks, though, are really looking longer term, 3 to 5 years or even longer. And so they may not be as worried about the short-term volatility. As far as traders are concerned, it's a great opportunity.
So, in a nutshell, Dodge, do you buy on the dips in the broader equities market, especially in the high-yielding universe where some of the valuations have been quite top-heavy, or are you looking for a deeper correction before you re-enter?
Probably a deeper correction before re-entering, although Pfizer, for example, had a correction today. We suspect that they'll be buying later on this week because people are not buying Pfizer for the fundamentals. They're buying it for the dividend, and over the longer term, there is sufficient cash flow. Despite the risk in one particular product, there's sufficient cash flow to cover the dividend.
Dodge, also, do you believe that, along with the consensus that there's a so-called federal put there in the U.S., that's one of the reasons, too, where if the economy does deteriorate, the Fed will step in and do some type of QE3 operation to support the market and the economy?
Absolutely, Yu-Dee. We don't expect QE before September. Bernanke doesn't typically create policy in front of Congress. But the economy is really at risk, and if it gets to be serious and there's a push towards the Fed coming in, then the Fed will come and support the market, and the market views that as an opportunity. We don't think it's going to happen soon, because if it were expected in our market, Yu-Dee, we would expect gold to be rising. We don't see that yet.
Dodge, do you think the U.S. economy is vulnerable to a recession? It's something that more and more people are starting to toss out there now.
Yes, Lisa, it's becoming more possible, although relative to the rest of the world, we appear, from just a purely economic point of view, less likely to have a recession. But the questions, even the question you're asking, Lisa, are becoming much more of a concern, much more negative. And so that the answer will come before the end of the year as to whether we really are going to have another chance at a recession.
Just back to Fed policy for both of you, gentlemen. Yu-Dee first. Jackson Hole, do you think Bernanke even, not Bernie, he's too smart to be a Fed chairman. Do you think Bernanke will will float any thought balloons on further stimulus at Jackson Hole? Yu-Dee first.
Yeah, I don't think so. I think basically from his testimony last week, I actually agree with Dodge there. Basically, he's saying that, well, we're going to wait and see a little bit. In my opinion, I think unemployment is the key. I think if unemployment rate gets above to be 8.5%, it's where the Fed will take some type of action, maybe some kind of operational, maybe extending the so-called Operation Twist or something.
What about you, Dodge? Anything constructive from Chairman at Jackson Hole?
I agree with Yu-Dee, and the way the QE may be implemented this time around may be a little bit different. I think QE is much more of a powerful weapon in not being used and being held off as long as possible than when it's used, because it really doesn't address the economic concerns that we're facing. So, but I think September will tell the tale.
Guys, let me throw something a little bit more controversial out there right now. Many of the world's major central banks, the Fed, the BOE, the BOJ, they're buying their own bonds, they're buying their own currency, they're essentially monetizing their debt. It's up for debate, but that's basically what they're doing. At what point will the major fiat currencies have to be backed by gold and other hard assets? Yu-Dee.
Well, that's a good question. I think basically you're absolutely right. That's why we keep saying, that's why the market itself actually, on the longer term fact, actually do not like QE. But on the shorter term basis, no doubt, by doing that, they will prop out the market. So you're right. So the question is, if you keep printing money, sooner or later, we're going to get in trouble. And that's why Dodge a little bit earlier was saying that, look at the price of gold. That will give you a little telltale sign also of how the market thinks about the Fed and the Fed's reaction. So I agree with you, what you said. I think on a short-term basis, some type of action, QE buying their own bonds is good for the economy, for the market, but the long-term effect there, wow, is very much questionable.
And Dodge, very quickly, we've got some people saying you might have to be backing up the dollar with gold within 5 years.
Possibly, but less likely relative to other currencies. I don't expect it.
All right. Thank you so much to both of you. Dodge Dorland from Landor and Fused Capital Managers. And we've got more to come with our guest host, Yu-Dee Chang. And remember, you can send over questions or comments about the show. We'd love to hear from you. Get in touch with me on Twitter. My handle is @LisaCNBC. Still
saving grace to what we are seeing now in the Eurozone, and that is the weaker euro. Clearly, that's benefiting the export-dependent economies like Germany. Is that the way you read it, Yu-Dee?
Yeah, I think that goes right back to the growth thing that I was talking about. The fact that to bring this out of the, in addition to be backing up by the ECB, also the entire Europe, the globe for that matter, needs a little bit of growth back. But don't forget, we're talking about a Spanish problem. A month ago, Spanish yield were above 7%, and before you know it, it went back down to about 5.5%. So I still think there's a possibility that people will work together to try to resolve it. I still think the possibility of the entire EU collapse is still slim.
Jay, can I put that question to you? Weaker euro, is that a saving grace in this whole crisis? And the flip side to that is that clearly the region is going to remain mired in recession for longer. How long?
Well, it's a marginal savings grace, but when you look at the external trade of the Eurozone to countries outside of the EU, it's about 20% of their GDP. So it's bigger than what the United States external trade is, but it's not like, say a Singapore or many countries in Asia. So it helps on the margin, but most of their trade is within the Eurozone itself, and obviously there's no exchange rate adjustments there.
Okay, Jay, thank you so much for joining us. That was Jay Bryson, global economist at Wells Fargo Securities. And we've got a lot more ahead with our guest host, Yu-Dee Chang. If you've got questions for him, shoot us an email. The address is squawk@cnbcasia.com.
Welcome back here. Let's get to Dominic Schneider, head of commodity research, UBS Wealth Management. He joins us around the desk here at the SGX. As much as commodities are a risk asset, and they often are, what are they telling you about what's going on over in Europe now?
Well, clearly the situation is not really great. You saw the base metals continue to slide. And if you remember what happened just a week ago, they barely moved up when the market got a little bit excited about the bailout. So really the market is looking here at the drag on the demand side and combining the impact, what it has on China. China is the largest consumer, and the weak data we got there was really a hammer for the prices.
So pricing in a slow to maybe no growth, certainly recession. What about help, policy action?
Well, policy action could help. It could just keep on the growth a little bit longer that we are. But at the end of the day, we are limited in terms of what we can do on the fiscal side. We're running out of bullets. So we really need to turn on monetary policy to really stimulate growth. China can do it. And that's why we were actually quite a little bit optimistic that on a 6-month horizon, what looks so doom gloom right now.
So by the end of the year?
By the end of the year, could look actually a little bit better. Some of the metals are really trading deep into the cost curve, which requires actually some production shut in at don't think that a lot of aluminum smelters in China can persist with the current prices for a long period of time, even on the nickel side. So those are the metals I really like if you have 6 months performance.
No, I want to bring Sri and Lisa in on this as well. We often talk about commodities and demand, China the big demand driver, etc. And if the economy is slowing there, that's why prices are so weak. Could it possibly also be because Chinese agencies are not in the market, at least not at this price? I mean, these guys aren't going to go in and buy high. They want to go in and buy low.
Well, we saw some weeks ago that actually prices at the London Metal Exchange was unfavorable for really big imports. That's true, but I think the recent weakness really makes some of the imports more attractive, even on the aluminum side. So you should see here some increased import activity once we come out of the third quarter, which third quarter is a seasonally weak quarter for base metal consumption in China. So I think that really coincides with monetary stimulus being a little bit growth supportive, that we're going to see higher prices.
I think you're onto something there. I think you're onto something there, Martin, because the Nexen deal, the CNOOC Nexen deal, it looks very opportunistic to me from a pricing perspective, because natural gas prices have come down, and that's being reflected in Nexen's price. So that's why CNOOC is in the market. But gold, Dominic, Yu-Dee earlier was saying that gold may offer a telltale sign of whether the market expects more QE, but it's been quite range bound. So that suggests that more stimulus from the Fed isn't coming in the near term.
Well, in the short run, the gold market clearly is not looking for a big QE on the horizon. And even if we're going to see here a sort of QE that is not like, which you try to reduce the liquidity on one side, so a sterilized QE, that's not going to bring a lot of change to the gold market. What the gold market wants to see, big balance sheet expansion, and I think that's what we will not get. What we see as of late, that prices go into a triangular formation, and that's probably going to call quite a big price move over the next 2 or 3 months. So here the triangular pattern is giving us indication for a directional shift, and it would really coincide with some monetary policy decisions or announcement towards the end of August in the US. So I think that's clearly one of the focus. From our side, we're still looking for lower prices. Our forecast is that no QE is going to materialize, and the market is heavily oversupplied. That's going to weigh on prices.
Okay, Yu-Dee, jump in
Dominic,
here.
also, we're talking about the slowdown of China, still on Europe. What about the United States? As we all know, they were reporting the drought in the U.S. There's over 1,000 counties. It's been declared in the drought stage. But what is the economic fallout of that to the U.S. of this drought? 1/3 of the corn crop has been damaged. Grain prices has went through the roof, and that affected feed prices and also the livestock prices. So, what's your opinion of the economic fallout of the U.S. drought?
Oh, the economic fallout. I would say overall the agriculture sector in the U.S. is rather small, so I don't see much of an impact at the end of the day. I mean, we have seen quite a strong increase in prices. Keep this in mind, 30%. And yes, yields have come down for a bit. We're talking about 166 bushel per acre. Now we're down to 146. So if you compare the downturn that we saw in terms of yields per acres on the other side, you see higher prices. I think that's a little bit of a balancing factor. But we see clearly risk that we're going to see even lower yields over the next 2 or 3 weeks, and that's going to make things worse.
Is it fair to say, as some have been saying, that we've seen the top in prices at $8 a bushel for corn?
No, don't think so. I mean, if you're going to see, again, a revision of 10% on the yield side, we're not going to see any increase in terms of the surplus that the market was initially expecting, and stock-to-use ratio might be even lower than we are right now, so around 6%, and I think that's really an alarming sign.
The feed-through, I don't know the answer to this, maybe I should, but let me ask you. Food, also transportation, how much weighting in the U.S. CPI? Because Americans, they got to eat still, right? In the huge continental nation, they need to drive.
To my knowledge, the food percentage of the CPI is around 10%, so they're barely going to make an impact. It's more important what's happening here in Asia, where food accounts for almost towards 50%, especially together with energy. So here it's watching what's going to have the impact on Asian inflation.
Well, let me ask you something very quickly, Dominic. We're almost out of time, but there's a growing concern out there in the market that as central banks monetize their debt, the Fed, the BOJ, the BOE, that eventually investors are going to demand that these currencies be backed by hard assets like gold and other commodities. As a commodities guy, are you factoring that into prices? Because some are predicting within 5 years we're going to start to see this.
Well, at the end of the day, what needs to happen with cheap monetary policy, or let's say loose monetary policy, is the demand gets really activated. And if we don't see demand getting activated at the end, you're not going to see that kind of inflation that you want. Keep in mind, all this liquidity that is provided is somewhere stored up with the banks, and it's not unleashed into the market and into credit activity. That's why I'm not so concerned that all this monetary policy is really finding its way into, pushing real assets so dramatically, as you mentioned. So from that angle, it helps, but it's not going to be the key driver. We need to see the demand.
All right. Thank you so much. Dominic Schneider there from UBS Wealth Management talking about commodities. Meantime, let's get the final word from today's guest host, Yu-Dee Chang of ACE Investment Strategist in Washington, D.C. He's been with us for the past hour, sticking through technical difficulties in the works. Yu-Dee, give us your top sector picks right now. I know you're a fan of energy.
Yeah, I like the energy a lot. I think the energy, the reason I like it is not necessarily for a bullish reason. I really believe over the longer term basis, let's say the next 2 years, there's going to be so much supply coming online. I believe energy prices are actually heading lower, probably below or around $50 per barrel. However, over the short-term basis, I think there's a lot of headline news events, a lot of geopolitical events will make energy prices oscillate and chop its way down. I like buying the lows and selling the highs. I think there's going to be so much opportunity in the energy sector using both bullish and bearish strategies. That's why I'm very much interested in the energy sector.
Okay, so it's not an investment for buy and hold. What do you think of the financials with this whole LIBOR scandal? We had the CEO of Barclays having to resign. What if we get some of the other banks that are being investigated in the exact same boat? Does this undermine the stability of the overall sector?
Yeah, absolutely. As I said, I think for the financial sector, to me, it's just not a sector for investment. You do have all these scandals, you have all the errors, and you also have so much unclarity in the U.S. regulations. You just don't know exactly what they're going to do. So I don't see a lot of financial clarities. The clarities in the financial sector. I think financial sectors is a very good trading vehicle as the economy, improves or deteriorates. I think there's a lot of opportunity also as a trading vehicle, but not as an investment either.
Okay. We've got a lot of investors over here in Asia today about to start a brand new trading session. They're not seeing a lot of clarity either. What's your advice? What's your single best piece of investment wisdom for them?
Well, I think right now, easier said than done, and people laugh at it. It's time to buy low and sell high. You cannot chase momentum. You cannot get sucked into a hype. You really have to pick the right stock and find the right valuation to buy it. A stock such as McDonald's, for that matter, right? People loved it at $100. Now it's coming down to the high 80s. People are worried about it, wanting to short it. I think this is a stage, maybe not right now, maybe in the low 80s, to me, actually will be a buying opportunity. So not easy doing it, right? Easier said than done. I think you need to find the right stock, the right sector, buy low and sell high. Not easy to do.
Okay, well, thank you so much for joining us today. We appreciate it. Yu-Dee Chang of ACE Investment Strategist in Washington, D.C. Stay tuned. We've got a lot more on Squawk. We're going to count you down to the start.